Hello and welcome everyone. Uh, Today we will discuss learning outcome 4, be able to interpret financial statement and make justified recommendation for business stakeholders. So welcome to the corporate reporting for business strategic. Self-assessment, you can check your knowledge up to 10 scale, rate your current knowledge of financial statement, 1 for not confident at all and uh, confident as possible 10. Indicative content, today we will discuss calculation of and interpretation of ratios, liquid ratios, profitability ratio, interpretation of accounting ratios and comparison of them to similar companies, justified recommendations and conclusion to meet need of relevant parties, are usefulness of ratio analysis when assessing and performance of a business, application of relevant accounting standards, for example, international accounting standards, IAS and IFR, as International Financial Reporting Standard and UK GAAP for FRS 102 and 105. Stakeholders to include shareholders, employee, potential investor, directors, managers, suppliers, lenders, government analysis. Current issue is corporate reporting may include accounting policy changes, developments in sustainability reporting, and materiality in the context of reporting. Uh, so let's get started. Our first topic, interpret financial statement using ratios analysis. Any comments, or if anyone is there can tell me what any have got any idea about interpret financial about ratio analysis? Okay, so when devel- uh, when delving ratio the realm of financial statements, it becomes imperative to disclaim the primary user of these accounts and be specific information they seek. Shareholders are potential investor, for instance, are chiefly concerned with not only receiving a satisfactory return on their investment, but also with gauging the stability and liquidity of the business they are invested in. So similarly, suppliers are lenders' priorities and security of their debt or loans. When while management team focus on scrutinizing the trend and level of profit, as the metric serves as a uh, important indicators of their success in steering the companies forward. Any questions so far, if anyone is there? But also keep in mind that financial statements are not only scrutinized by these key stakeholders or other potential user, including if financial institutions, employees, professional advisors, for example, financial advisor or investment advisor, financial journalists, and commentators. So each of these parties seek, pertain insight from the financial data presented, tailored to their specific interests and concerns. So, for example, while financial institute may assess the credit worthiness of the company, employees may look for indicators of stability and growth within the organizations. Ratio analysis. Ratio analysis serves as a powerful tool in dissecting financial statements, so offering valuable insight into performance and financial health of a company. So these ratio are, derived from simple calculation that encapsulate the interactions within the set of financial data. For example, changes in cost of sale are intrinsically linked to variation in sales activity when in in turn impact wages, receivables, inventory levels, and other aspects of the business. Ratios provide a successful means of visualization. So these, intricate relationship is comprehensible, a format, thereby facilitating a deeper understanding the company's financial dynamics. Uh, Ratio also provide a, sufficient means of visualizations. These in create, a relationship. So it is important to note that ratios, when analyzed in, isolation, often limited utility to drive meaningful conclusion and actionable insights. So from ratio analysis, it is essential to adopt a comprehensive approach. So this involves considering a range of ratios and metrics along with their qualitative and quantitative factors. So to gain a holistic understanding of the company's performance and financial positions. So understanding financial ratios are essential tool in, analyzing a company's financial health and performance. They provide a quantitative means of assessing various aspects such as liquidity, profitability, and financial positions. So one of the fundamental ratio used to evaluating liquidity is the current ratio, which comprise a uh, company's current assets to current liabilities. So similarly, the quick ratio, also known as, if you can see here, quick ratio. So the quick ratio, known as the asset test ratio, provide a more significant measures to liquidity for excluding inventories from current assets. This ratio assesses to company's ability to meet short-term obligations without relying on the sale of inventory. Another important aspect of financial analysis is assessing a company's ability to cover its interest expenses, which is measured by the interest cover ratio. So the ratio compares the profit from operations to financial costs and indicate how many times company's earnings cover its interest expensive. Gearing, on the other hand, focuses on the proportion of a company's capital that are focused by debt. So it uh, compares non-current liabilities to equity and non-current liabilities, providing insights into the company's financial leverage. Any questions, any concerns? Can you see my screen, anyone, if anyone is there? Okay, so detailed explanation of financial ratios, return on capital employed, if you see return and total assets, returns on equity, gross profit percentage, expense revenue percentage, opening profit percentage. So, return on capital employed measures the efficiency within with which a company utilizes the capital to generate profit. It is calculated by dividing the profit from operating by the total capital employed, equity and non-current liabilities expressed as a percentage. Inventory turnover, if you look at here, so the ratio assess how efficiently a company manages its inventory by measuring how many times during a period the inventory is sold and replaced. It is calculated by divided the cost of sales by the average inventory level. Return on total assets evaluate the profitability of all assets employed in the business. It compares the profit after tax to the total assets expressed as a percentage. Inventory holding period. This ratio indicate the average number of days it takes for a company to sell its inventory. It is calculated by dividing the average inventory by the cost of sales and multiplying the result by uh, 365 days. Trade receivable collection period. uh, Trade receivable collection period. This ratio measures the average number of days it takes for a company to collect payment from its customers. It is calculated by divided the tradable receivable, if you can see, by revenue and multiplying the result by 365 days. Trade payable payment period. This ratio assess how long a company takes to pay its suppliers. It is calculated by dividing the ratio payable by the cost of sales and multiplying the result by 365 days. Return and equity ratio uh, means the return generated for shareholders' equity. It compares the profit from operations to the total equity expressed as a percentage. Gross profit percentage, the ratio indicates the proportion of revenue retained as a gross profit after deducting the cost of goods sold. It is calculated by divided the gross profit by revenue and multiplying by result by 100%. Uh, then expense revenue percentage this ratio assess uh, the proportion of specified expenses relative to revenue. It is calculated by dividing the specified expenses by revenue and multiplying the result by 100%. Operating profit percentage. This ratio measures the operating profit as percentage of revenue, providing insights into operational efficiency. It is calculated by divided dividing the profit from operating by revenue and multiplying the result by 100%. Then working capital cycle. The working capital cycle measures the time it takes for a companies to convert in current assets into cash and then back into cash again. It is calculated by subtracting the payable days from the sum of the inventory days and receivable days. Uh, Assets turnover, total assets and net assets, asset turnovers ratios assess how efficiently uh, a company utilize the assets to generate revenue. The total assets turnover calculated by dividing revenue by total assets. Uh, while the net assets turnover is calculated by dividing revenue by total assets minus current liabilities. Both ratios are expressed as time. Any questions so far, if anyone's there? Okay, so next is financial statements, objectives of financial statements and interpretation guidelines. Uh, the primary objective of financial statement is to assist users, both internal and externals, in making informed economic decisions. External users such as investors, creditors, uh, and analysts interpret financial statements to gauge a company's financial performance. Liquidity and resources utilization in assessment, students may to toss with the calculated ratios. So comparing them to previous periods to industry, average and providing insightful commentary on their implications. Additionally, students may be required to suggest strategies for improving specific ratios and communicate their finding effectively through reports, letters, or emails tailored to the intended audience interests and decision-making needs. Any questions or any concerns? Okay, so return on capital employed, uh, this is basically understanding return on capital employed is an important financial metric that evaluate the profitability and efficiency uh, of a company's capital utilization. It is calculated by divided the profit from operations uh, by the total equity plus non-current liabilities. So multiply by 100. So ROCE or return on capital employed indicates the overall return generated by the companies on both debt and equity capital in a sense. So it measures the effectiveness of utilizing available resources to generate profits. So ROCE is influenced by two primary factors, profitability and asset utilizations. You uh, Profitability and assets utilization. Profitability is assessed through metrics like operating profit percentage, which compare profit from operations to revenue. Assets utilization is evaluated using metrics like assets turnover, which measures how efficiently a company uses its assets to generate sales. Higher ROC value signify better performance in both profitability and resource utilizations. Profitability. Return of equity and profitability ratios. Return on equity and uh, assess the return earned or ordinary shareholders on their investors. It is calculated by, dividing the profit after tax by the total, by the total equity. So multiply by 100. So ROE specifically focuses on the return generated for equity shareholders, excluding any influence from debts financing. Profitability ratio provide insight into a company's ability to generate profit ratios to its revenue and expenses. The operating profit percentage, also known as the net profit margin, compares the profit from operations to revenue, including the overall profitability of the business. The gross profit percentage measures the a proportion of revenue retained as a gross profit after deducting the cost of goods sold. Both ratios are expressed as a percentage. So, express revenue percentage can be calculated for operating expenses in total for the specific expenses. So basically, express revenue percentage is an important indicator of a company's cost management efficiency. So it can be calculated for total operating expenses for specific expenses by divided the expenses by revenue and multiplying the result by 100%. A higher expenses ratio typically leads to a lower operating profit percentage. Uh, a high, a higher the highlighting the importance of controlling costs to maintain profitability. Assets turnover ratio evaluate how effectively a company utilize its assets to generate revenue. It is calculated by divided revenue by total assets or total assets minus current liabilities. Higher assets turnover ratios indicate more efficient utilization of assets, resulting in increased revenue generation per unit of assets investment. So this matrix helps assess by efficiency and productivity of a company's assets management strategies. Understanding liquidity ratios are essential indicator that assess a company's ability to meet its short-term financial obligations promptly. Current ratio compares current assets to current liabilities, indicating the extent to which current liabilities are covered by cash or other liquid assets. It provides insight into the company's overall liquidity positions. The quick ratio uh, also known as the asset test ratio, is a more stringent measures of liquidity as it excludes inventories from current assets. So this ratio reflects the immediate solvency of a business by focusing on assets that can be quick covered into cash to meet short-term liabilities. Now, working capital and efficiency ratio, inventory turnovers, and inventory housing period measures how efficiently a company manages its inventory. So, inventory turnover compares the cost of sales to average inventory levels, indicating how quickly inventory is sold during the year. Uh, this inventory, this inventory holdings period calculates the average duration for which inventory is held, providing insight into inventory management efficiency. Trade receivable collection period assess how quickly a company collects payment from its customers, while the trade payables payment period measures how long it takes for a company to pay its suppliers. Both ratios evaluate working capital management and cash flow efficiency. The working capital cycle, calculated by subtracting the payable days from the sum of inventory days and receivable days, provides a comprehensive view of how efficiently a company manage its working capital. Any increases in these periods may indicate potential liquidity issues that requires attention. Financial position and gearing ratios, interest cover. So financial positions and gearing ratios, uh, 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 also known as leverage, compares the proportion of debt capital to equity capital in a company's capital structure. So it is calculated by dividing non-current liabilities by the sum of total equity and non-current liabilities. So gearing ratios indicate the level of financial risk associated with the company's capital structures, with higher gearing suggesting gearing reliance on debt financing. Then interest cover. Uh, Hi, Hinesh.
Hi, Azir. Sorry I'm late.
No, that's fine. No problem. That's fine. Are you okay?
Not feeling too well, but
Oh,
otherwise I'll be
oh,
okay.
oh, okay. So I'm just explaining, that I think so. We discussed in our previous lecture as well, ratios, if you remember that. So
Yes.
it just basically is a repeating, uh, bit in depth. So, uh, interest cover assess a company's ability to meet its interest obligations from its operating profit. It is calculated by, divided profit from operations by finance cost, then multiply by 100. So higher interest cover rates indicate that the companies generate sufficient operating profits to comfortably cover its interest expenses, reducing the risk of financial, uh, distress. So if you remember, there was both companies of financial ratios are powerful tool for evaluating companies' performance and financial. So the gross profit ratios calculated by divided gross profit by divided gross profit by sales and multiply by 100 measures the percentage of sales revenue retained after deducting the cost of goods sold. Similarly, the operating profit ratio assess the profitability of core operating by dividing profit from operations by sales and multiplying 100. Gearing ratios provide insight into a company's capital structure and financial risk. The debt to equity ratio compare debt to equity, indicating the proportion of financing providing by creditors relative for shareholders. Alternative gearing ratios offer additional perspective on the company's debts burdens, highlighting its reliance on debt financing. Interest cover ratio assess a company's ability to serve its debt obligations. So, calculating by dividing profit uh, from operations by interest paid. This ratio indicates the number of times operating profit covers interest expenses, providing insight into the company's financial stability. The assets asset test ratio, also known as quick ratio, evaluate a company's liquidity by measuring its ability to meet short-term liabilities using its most liquid assets calculated by subtracting inventory from current assets and divided by current liabilities. This ratio assess the company's immediate solvency. So, a trend or a vertical analysis, if you can you see my screen, Hanesh?
Yes.
Okay, okay. So basically here he's discussing trend or vertical analysis. Trend or vertical analysis compares a company's current financial performance to its historical performance. So by adjusting past results for price changes and analyzing trends overall over time. So this methods helps identify patterns and assess performance relative to previous periods. So a limitation of but a limitation of the this analysis is the lack of independent benchmarks, making it challenging to determine whether the company's current results are favorable or unfavorable. Horizontal analysis to address the limitation of vertical analysis. Horizontal analysis compares a company's performance with that of similar companies in the same industry for the same period. Just a minute. Yeah, so this introduced a same industry for the same period. So this introduced an independent, yardstick for comparison, adding in assessing a relative performance. However, selecting a comparable company of similar size and operating in the same industry is important to ensure meaningful comparisons. Despite its benefit, a horizontal analysis may still be, subject to criticism if the chosen competitor exhibits, exceptional performance, so influencing the overall analysis. Industry average comparison. Uh, this involves evaluating a company's ratios against the average ratio of similar companies in the industry. So this analysis provide valuable insight into a company's performance relative to its peers to helps identify areas of strength or weaknesses. So by subtracting two schemes, the compile and anonymize ratios data from various companies. Businesses can access comprehensive industries benchmarks without bias. So such analysis is important in uh, uh, you know uh, s- uh, uh, scenarios like acquisition decisions, investment assessment, or loan evaluation. So where stakeholders require objective insights into a company's financial health. Consider business strategy. Uh, when interpreting financial ratio, it is also important to consider the a broader business strategy and whether the companies has plans to address any identified weaknesses. Ratios may highlight areas needing improvement, such as liquidity or profitability, prompting strategic adjustments. Implementing changes and turning around a business takes time, so and outcomes may not be immediate. Also, ratios reflect historical performance and may not capture the full picture of a company's strategic decision or future prospects. So user of financial statements serves need for information in financial statement. Financial serves various stakeholders, each with distinct information needs. Investors rely investors, rely on financial statement to assess investment opportunities, evaluate dividend perspectives, and make buy, hold, or sell decisions. Lenders use financial statement to gauge a company's ability to repay loans and interest on time. Uh, Suppliers and creditors assess a company's credit worthiness and payment reliability. Customers may seek reassurance about a company's stability and continuity. Governments and government agencies and public use financial informations for regulatory purpose, government tax policies and economic analysis, contributing to transparency and accountability in the business environment. So public interested in the contributed of entities to the local economy. Make justified recommendation based on financial statement integrations. Uh, Analyzing financial statement requires careful consideration of various ratios and indicators to make informed decisions in the case. So comparing Pepca Limited and Anika Limited reveals offering strengths and weaknesses. So PEPCA demonstrate better gross profit and operating profit, indicating higher profitability compared to ANICA. This is talking about, the previous ratios in comparison, but we discussed in our previous session as well. So ANICA exhibits superior ratio in terms of gearing, interest covers, and asset test suggests lower financial risk and better solvency here. So describe PECCA's strongest profitability and ICA's healthier financial positions and lower risk profit make it more, prudent investment choice. And ICA's ability to manage debt levels, meet interest payment, and maintain liquidity outweighs PEPCA's higher profitability. It is advisable for investors like Louis to consider investing in Anika for a more balanced risk return profit. So, analyze solutions to current issues in financial reporting that may affect the interpretation of the financial statements. Have you checked your learning management system, Hinesh? Have you find any or anything?
I had problems accessing.
Mhm.
I'll check again today.
Okay, okay, okay. So just let me know if there isn't anything that I will ask them to, open complete learning management system or upload stuff for you. Okay.
Yeah.
Financial statement manipulation, a form of accounting fraud, remains a significant concern in corporate America, despite regulatory efforts to curb it. So inherent challenges lie in management incentives, the board discretion permitted by accounting standards, and the potential conflicts of interest between auditors and their corporate clients. Investors need to be vigilant and equipped with the necessary tools to detect warning signs of financial manipulations, understanding the you know issues of financial reporting, identifying irregularities, and scrutinizing management practices are essential for mitigating the risk associated with fraudulent activities. Financial statement manipulations persists as a genuine threat, impacting investors and regulatory companies' efforts. Alike managers may manipulations financial data to deceive investors to meet performance targets for executive comparison. The flexibility and interpretive nature of accounting standards create opportunities for manipulations, making it challenges to detect fraudulent practices. As a result, stakeholders must, remain vigilant and employ due diligence in analyzing financial statements to uncover potential discrepancies and potential, their interests. What happened with them? Okay, so here basically Encore scandal 2001 uh, rocked the business world, revealing one of the largest cases of corporate fraud in history. Have you ever heard about Enron scandal? Uh,
Yes. I heard how they manipulated the overall liabilities, um, especially
yeah,
with the auditors. The auditors claimed that they followed the audit process, but it wasn't considered diligent or enforced well enough, and they also were fined. I think it was Arthur Anderson,
Yeah,
the
yeah.
auditor at the time, and it also meant that the audit industry was revamped and re-governed by regulators.
Yeah, it's basically once America's most innovative companies was exposed for keeping enormous debts of its balance sheets, leading to a massive loss of $74 million or billions for a shareholders. So thousands of employees and investors lost their retirement saving, and the companies uh, filed for bankruptcy. CEO, Jeff and former CEO Canley faced penalties uh, with Skilling receiving of a 24 years prison uh, sentence, but I think so Lay passed away before serving time. So the scandal was brought to light by internal whistleblower Sharon Watkins, and suspicious were fueled by companies' high stock, prices. So
I
there are
mean,
many other.
yeah,
Yeah,
there are other companies before this in the UK.
yeah,
Guinness,
that's why.
the company that dealt with beer, their own chief executive, their other executives, they continue to manipulate the share pricing. They would,
Yeah, definitely. I don't remember, but I heard about Amazon. They had some issue previously. Then in basically it's a USA based company, but they had some issues. And then Sports Direct, there was some, financial fraud kind of issues was there as well. So there are many companies, that they never stop doing these kind of stuffs. And Hanesh, they can't do without, support of lawyers, accountants, and auditors.
yeah, but if the client is very large,
Oh,
and this
yeah.
is that's worrying, that audit industry is being suppressed, or they are felt that they are obliged to protect their clients when their clients are the ones who are not following what is expected and what is being regulated. And that's why FSA wasn't considered a very good regulator, because they didn't understand the mechanics
Yeah.
of how financial services actually uh, traded or manipulated the arbitration of trade. And this is how so many companies also fail to meet their tax obligations. And VAT is the biggest fraud in the world.
Oh, yeah. VAT is definitely. It's the biggest frauds. But the problem is, as you said now, FCA is not capable.
Mm.
Uh, FSA, sorry.
FSA.
Yeah. So, but same time, that they get, very much flexibility from tax offices as well. You know, some
Mm.
com some companies are, what shall I use? You can say blackmailing, that investment kind of purpose, foreign companies, they
Yeah,
always,
corporate blackmail or corporate bribery, as in
yes,
psychologically,
yes,
they are bribing the tax authorities.
yeah,
Google, Starbucks, all these companies claim that even though they have physical
yeah.
presence in the UK, they are
So,
able to claim that their profits are actually earned outside of the UK territory.
So I'm not saying that is government trying to get their taxes and they're keen on their financial obligations, but companies investments, if you look at, they always invest conditionally, you know.
Mm.
So everything is, they might decide everything before investment. If, let's say if Amazon or you said Starbucks or any other company comes to the UK, they there is a deal behind their investment as well, you know, regarding
Yes.
tax or taxes or some other stuff like that, what you said, UK, you know.
Yeah. Yeah. They renegotiate their.
Yeah, renegotiate. It's it's everything is, behind the curtain. Front face is a different one. Okay.
Yeah.
So that's the main problem or main issues. Okay.
Yeah. Yeah. And people, society, stakeholders, they rely on the credibility
Yeah,
of.
you are a practicing accountant, and you know very well that this is not only a large company. If you look at small businesses, they're trying to hide stuff. You know that this is everywhere,
Yeah.
everywhere.
Yeah. Yeah. I mean, whistleblowers, if
Yeah,
they say anything within the organization, they're crucified,
yeah,
and they lose their career. And the problem with financial services is that once an organization black marks an employee, they will never ever be able to find a job within banking, insurance, or
yeah,
brokerage ever again. And the regulators are misinformed. And they also have a list of individuals or uh, groups that they are not that will never ever be certified to work in that industry,
yes.
and that can be manipulated, and again, falsely falsely accuse an innocent group of people.
You know, some people don't understand, especially like our main, like you are studying IFA, and there's main target companies are small and medium enterprises. Okay.
Yeah.
So if my understanding is some people are paying, that like if you in term of bribery, I'm talking about overall, that not only in terms of UK, if because IFA is working in some other companies, people are
Mm.
paying, in more money in or more, that more than taxes in terms of bribery or penalties or stuff like that. If they do pay proper tax, I think so everything will be fine, and there won't be an issue for them as well.
Yeah, it gives peace of mind
Yeah,
throughout the community, and on top of that, there's credibility assurance and best practice, and it pioneers the way for transparency, openness, and honesty. I mean, the corporate governance is another
yeah,
form of religion. It's written to tell us what good behavior is,
what good
what,
behavior is. Yeah,
but there's always one who will always be the serpent, who will challenge that and question that and put fear and doubt in others. And when you try to do the right thing, you are crucified. And problem is, when you're crucified, it's too late.
yeah,
Too much pain, too much hurt. It affects people's health. It brings uh, the new generation into doubt. They don't understand what is right and wrong. There's so much confusion. You know, we're in a modern world where if you speak up and you
yeah.
try and do the right thing, those in power will claim that uh, you're wrong, and they will humiliate you in front of others. And there are people who are doing the opposite, and they get rewarded.
Yes. There is another problem, that uh, people, some people, or they don't use accountants, solicitors, and auditor for for positive purposes. They start from a wrong thinking. That we will
Yes.
they go basically for to get advice of how we can hide taxes, how can we hide this stuff, how can we hide, you know what I mean, that they don't
Yeah,
go for hide purposes.
yeah.
Okay.
They try to be creative, but the substance.
Yeah, I
Uh,
was talking to one of the guy regarding his small business taxes and things. So he said, "Oh no, I will go. I have my financial advisor. That he can tell. He's telling me that if I do like this or that, I can hide. I don't need to show this. That this is not a kind of advice, and this is not a kind of that tax evasion or tax. That uh,
mm,
you can resolve your tax issues.
yeah, yeah. I mean, cryptocurrency
Yeah.
has
See
an
that.
audit trail.
What do you think about cryptocurrencies? It's kind of, that lots, I heard that lots of people, to be honest, I don't know much about, but lost their money or investment in
Yeah,
cryptocurrency.
yeah, and it's because of brokers who are able to manipulate the investors' monies in such a way. I mean, there's huge cases right now. There's a case right now where there's a company called FX, which manipulated uh, people's digital currency investments and stole their monies. And it was, this company was founded by a teenager, and he became billionaire because it was a global transaction. And this is the problem, that the officials, the regulators, they don't understand, how these culprits are managing to steal the money before they even get the license to to basically carry out their business. And this is a problem that a lot of companies can be set up very quickly. And the film Big Short also shows how the regulators, great example of how they didn't understand how a lot of these collateral debt
Yeah,
obligations and brokerage investments were working, and they just gave them license to operate, and people lost huge amounts of money, and and
yeah.
and the trust within investment banking was destroyed.
Yeah, so I think so that in that case or all similar cases, you're right that that regulatory bodies are responsible as well, as you said, FSA or FCA. That.
Mm,
So they are in somehow they are involved, or if not, they are responsible for it as well.
yeah, there's accountability
Yeah, there's
to
no
be there.
accountability.
Yeah,
There's no, that not we think that they do. That it's a common perception that they investigate everything. They look at everything, but see that how many frauds and how many companies which are registered with the company houses, or they are approved by FSA or FCA. So but basically they don't even physically present,
yeah, yeah,
just people use for a fraud purposes, or just for that money laundering or stuff like that. There are many things, that there are too many things,
yeah. It's very, very complicated now.
very, very complicated. And uh, I believe that they can't do without, external help, like, regulatory bodies, or auditors, or tax offices, or
Mm,
CAs, or accountants, or solicitors. I don't believe they can do without their help.
yeah, yeah. I mean, that's why IFRS, International Financial Reporting Standards,
Yeah.
they those rules or those guidances and examples are there to give uh, knowledge on and positive examples of how stakeholders should be aware of what parameters they should follow, and how it can be applied in the correct to avoid it, all these kind of scandals. I mean, these scandals are very old, you know.
Oh yeah.
But even now, you know, Deloitte, KPMG, they're being fined, and they're not being fined for just a couple of million here and there. They're being fined hundreds of millions of dollars or pounds.
Oh
Uh,
yeah. Also,
even now,
that if you're talking about like I can see here in front of me WorldCom scandal 2002, and that was that Encon 2000 Enron 2001.
yeah,
Even things wasn't digitalized that time. The technology wasn't that much involved. So nowadays, everything is in front of your computer.
yeah,
Just your fingertips.
yeah. But this is how digital currency is being manipulated.
Yeah. Yes, that's right. That's right.
These brokerage agents, where you have the financial data showing the trade of the buy and sell of the currencies, they are able or have found ways to actually hide or
Yeah.
destroy that data or make it corrupt. So then people lose track of their accounts, or they don't know what's happening to the funds, and it's basically been stolen and transferred across elsewhere.
And
Uh,
also supportive by many authorities. You know that.
yeah, yeah,
Supportive mean that approved by from everywhere. Everyone was talking about cryptocurrencies.
yeah, 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 exactly. I mean, I tried to introduce SOX into one of the firms, and there was a huge delay by decision makers. They kept throwing back a volley, just ask, what's the purpose of this? Why is this? How much is it going to cost? When can we leave it till, you know, rather than implementing phase uh, implementation, they would say, well, we'll do it in one hit, and we'll do, and we want the whole project to look at how to install this in one day, as opposed to
Yeah.
generally phasing in individual aspects and processes and policy. They didn't want to put it in the small stages, which then just delayed the matter. And in the meantime, financial information is manipulated in such a way that it shows targets were hit, and those targets, once they're hit, they reward those decision makers. So there's a personal agenda there, and these authorities don't cotton on to that until it's too late.
All right. So anyway, so next one is WorldCom scandal. So again, WorldCom scandal in 2002, a telecommunications company inflated its assets by as much as $11 billion, resulting in 30,000 job losses and 180 billion in losses for investors. So CEO Baron Abbas was found guilty of underreporting line costs and inflating revenues through fake accounting entries. Okay, so see that that fake accounting entries.
Yeah, and that's where they uh,
Yeah.
place valuation on assets that
Yes.
haven't been carried out due diligence and validated. And I've seen this on a personal level, where I I see a huge rise in the valuations, and these are then booked against the reserves. But then
Yeah.
you ask for the backing documentation, you ask for supporting evidence, and it's that's the duty of the financial team. you know, that it is their duty to carry out internal audit and to verify that before the event of year end, before the event of external audit, to build confidence. And these things are delayed, or
Yes.
these things are forgotten. And when you highlight them, unfortunately, individuals or groups within the finance team are considered troublemakers.
So, guilty of fake accounting entries. So, WorldCom's an internal auditing department uncovered 3.8 billions in fraud, leading to their CEO Bernie Ebbers, convictions and a 25 years imprisonment for fraud. Okay, a prison sentence. So this company filed for bankruptcy, and Congress responded by passing the Sarbanes-Oxley Act, introduced the most sweeping set of new business regulations since 1930. So American insurance group scandal. There is an I heard about AIG now as well. Still, I think so. They are
Yeah, they're one of the biggest
yeah,
American corporates, and during recessions, insurance companies like AIG and pensions, they continue to prosper. So
yeah,
whilst the banking, high street banks are suffering, or they're being uh, regulated very heavily, both in the northern hemisphere as well as in Australia, Asia hemisphere. Globally, they continue to prosper within the insurance and pensions industry, and that's because they have government backing on
yeah.
mandatory insurance policies for life assurances, and people, don't claim. So this is extra money for the bondholders, who usually are also the decision makers within that um, global or SME platform.
So so when was happened? 2005, American insurance group scandal came to light, involved massive accounting fraud totaling 3.9 billion, along with allegations of big rigging and stock price manipulations. CEO Hank Greenberg, uh, how did how he did it, directing clients to insurance with payoff agreements and instructing traders to inflate stock prices. Uh, AIG settled with the SEC, settled with, I think, the stock exchange company for
Yeah,
millions of dollars, but faced no criminal charges despite posting record losses and receiving taxpayers' bailout. So AIG executives rewarded themselves with hefty bonuses and sparking public outrage. Okay, yeah,
yeah, and yeah, it still continues to operate.
yeah, still continue to. I heard that it's a quite big company. You know that.
Yeah, so it just shows you how governments it succumbs to these corporates, because it affects their economy, affects people's lives on a big scale. It affects the other
Yeah, as I
stakeholders.
said, Hanesh, this is a truth. They always talk behind the curtains. You know that front face is a completely different. Okay, so it's a government always in somehow government, or that financial agencies, they support them as well. You know that, or there
Yeah,
is not support, but I can say that they rescue them. Okay, they might tell them, "Oh, how can you clear yourself by using this stuff, things
Yeah,
like.
yeah.
So yes,
But
they are.
the CEOs, they've still managed to get their agenda, which is even if they're in prison, they've already got their rewards already, and it's protected. And they're protected because these people use planners, financial planners,
Yes,
tax
financial
where
planners.
they hide the rewards. A great example is the Lehman's CEO. Richard was able to earn within a space of 5 years, earn a remuneration of more than $250 million, and all that money went into assets, not in his name. So they couldn't, the lawmakers couldn't retrieve those assets and place them back to pay off the creditors, the investors. And then Lehman's Brothers, the oldest bank in America, went into liquidation. So, he may have spent, the CEO may have spent time in prison, but
Yeah, I
he'll
think
find a
so.
way to still enjoy once he's out of there.
Yeah, I think there is Lehman Brothers as well. Oh yeah, here it is. Yeah,
Yeah, there you go. And they were based here
yeah, here it is here.
in
2000.
London.
Yeah, yeah, they are. It's quite. I think so. It's an investment bank, isn't
Yeah,
it?
it was one of the oldest
One
investment
one of
banks.
the old that's and very well known.
And they again, the CEO manipulated the loans where it was 40 times more than the capital that was actually within the organization. And the regulators didn't pick that up. They didn't understand that because, as I said, nobody carried out due diligence.
So, Lehman Brothers scandal in 2008 further shocked the financial world as the global financial services firm was found in have hidden over $50 billion
Yeah,
in a loan disguised as sales executives allegedly sold toxic assets to uh, where is a Cayman Island banks, creating a false uh, impression of the company's financial health. Lehman Brothers bankruptcy become the largest in U.S. history through the SEC did not prosecute due to lack of evidence. Despite its downfall, Lehman Brothers had been ranked as the most admired securities firm by Fortune magazine just a year earlier. So the basic is still they are working, Lehman Brothers, still they
no,
are.
no. Today in today's world, Lehman's Brothers is no longer
I
exists.
they are in another name. But might be.
Yes, they've had to change
Yeah,
their whole identity, but the
yeah,
name
that's what I'm saying, that they
Brothers
are
doesn't
still in
exist.
practice or they're still in business, but using another name. I heard that it's the same, management, same, executives and directors are behind new companies. I don't know which one is it, but they are still in business.
Yeah, and yet there's a UK ruling that disallows directors who've been prosecuted or have been found to be involved within these corruptions, and yet they continue to trade or continue to be able to operate. So it's a double whammy um, to society that they got away with it, and this is something that I've spoken to a corporate psychologist, psychiatrist, and they've explained where there is a very smart individual who is very good at achieving results through whatever form, their main agenda in their young life is how to make money very, very quickly. And they have two choices in life, or two paths to follow to make that, to achieve that objective. The first one is they either go through criminal activity and become and work in crime and become the world's biggest smuggler or the world's biggest slave trade in the world, or they achieve professional standing and they then work at a corporate level, and they rise very, very quickly into a position of authority and power. And then they continue to manipulate the markets, manipulate people, manipulate the rest of the world in such a way that they become too powerful to be able to get rid of, and they can sustain themselves going through the process. And even car industries, Nissan, again, the valuation of their assets was manipulated to show falsely. And who got rewarded for reaching those targets? Again, the CEO. So it's very difficult.
Yeah, there are many companies, right. So next is definitions, process, basically creative accounting is a term that describes the process whereby accountants use knowledge of accounting rules to manipulate figures reported in the accounts of a businesses, according to Blake, Emmett, and Dodds, 1998. So transformation of financial accounting figures from what they actually are to what prepares desired by taking advantage of existing rules and or ignoring some or all of them. So these definitions basically highlight the deliberate nature of creative accounting, where financial figures are adjusted to present a desired narrative rather than an accurate reflection of the company's financial position. Why use a creative accounting? Reason for using creative accounting, the motivations behind employees' creative accounting practices stems from increasing emphasizes on shareholders and market reactions to managerial actions. Directors are often judged based on metrics such as profit growth and earnings per share, EPS, with significant bonuses tied to these performance indicators. Consequently, companies and directors may feel compelled to manipulate financial reports to convey a specific message to investors. So, in a sense, creative accounting is used as a tool to shape perceptions and influence investor sentiment, particularly when there are incentives tied to financial performance. Creative. So, also, concealing poor performance, company may, hide a company may resort to creative accounting to hide a particularly bad year for the businesses, avoiding negative repercussions on shareholders' confidence and market, perceptions. Force an exceptionally good year, continue the pressure to always be the best, smooth out results to give an impression of stability, impression stability or sustained improvement. So boost assets to avoid takeover. So basically creative accounting may use for employee to perpetuate the a pressure to consistency outperform competition. So by smoothing out results to uh, quarterly stability or sustained improvement, companies can maintain their competitive edge in the market. So boost assets to avoid takeover. Uh, Creative accounting is used to boost assets artificially, making the companies appear more attractive and less, susceptible to takeover attempts. Um, Basically, they engaging in creative accounting can create a cycle of distortion where the need to manipulate figures in one year may lead to a heightened need to for future manipulation subsequent years to maintain the phase of financial stability or financial growth. So again, how accounting regulators curb creative accountants. Uh, Accounting regulators implement various measures to mitigate the practices of creative accounting, reducing scope for choice of accounting methods means regulators aim to limit the flexibility in choosing accounting methods, thereby standardized reporting practices across industries. By minimizing the range of acceptable accounting methods, they seek to reduce the opportunity for manipulations. Then limited judgment and estimate uh, regulator seeks to minimize the use of subjective judgment and reduce the scope of estimation in financial reporting. Uh, this approach helps to enhance the objectivity and reliability of financial statements by relying on more concrete and verifiable data. Substance over form. Regulators emphasize the importance of substance over form in accounting treatment. So this principle requires companies to account for transactions based on their economic substance rather than merely their legal form. So ensuring the financial statement provide a true reflections of the underlying economic reality. Last one is prescribed revaluations. Regulators may prescribe specific guidelines for asset revaluations to ensure consistency and transparency in reporting the value of assets by mandating revaluations practices. So they aim to prevent manipulations related to assets valuations. Then one of the motivations behind creative accounting in income smoothing, which involves reporting a steady trend of profit growths rather than volatility profit characterized by dramatic fluctuations. So this practices serves several purposes, avoiding high expectations. By smoothing income, companies can avoid raising expectations too high in a good year, thereby preventing disappointments in subsequent years when performance may not meet elevated expectations. Then long-term concealing income smoothing may also be used to conceal long-term, changes in profit trends, presenting a consistent image of stability to stakeholders. uh, Big both. So, big both approach in cases where a company experiences significant losses. The big both approach involves maximizing the reported loss in particular year to create a lower base for future profitability, make subsequent years appear more, favorable by comparison. Uh, apart from income smoothing, manipulating profit to tie in with forecast, company may, manipulate profit to align with forecast figures, ensuring consistency between reported earning and market expectations. Distinctions from unwelcome news. Okay. Obviously affect business market. So creative accounting may involve implementing income boosting accounting policy changes to divert attention from unfavorable development or news. Share price maintenance, share price manipulating profit can be aimed at maintaining a boosting share prices by creating the appearance of a positive profit trend and reducing apparent levels of borrowing. Delaying release of information for market uh, may be used to delay the release of information to the market, potentially allowing insiders to engage in illicit trading practices. Some common methods of accounting manipulation, excessive provisions, extraordinary items, uh, off balance sheet finance, excessive provisions. Uh, Companies may overstate provisions such as reserves from bad debts or warranties to artificially decrease reported profit in a particular period, thus smoothing income over time. Extraordinary items not allowed anymore. Uh, Companies historically used extraordinary items to classify one-time events separately, potentially making ongoing operational issues. Uh, Off-balance sheet finance, companies may utilize, off-balance sheet arrangement to keep certain assets or liabilities off the balance sheet, thus distorting the true financial position of the company. So capitalized cost, capitalize such as research and development expenses or marketing cost instead of expensive them immediately can inflate reported assets and improve profitability in the short term. Non-trading profits, some companies may generate profit from non-core activities or investments, which can be used to boost reported earnings without reflecting the true performance of the core businesses. Brand accounting, intangible assets like brands may be overvalued or manipulated on the balance sheet, leading to inflated assets values and potentially misleading financial statements. Ethicals is creative accounting. Ethical implications of creating accounting are subject to debates. Okay, so there is the fine line between legitimate financial management techniques and unethical manipulations. You can see that some key points are here: legitimacy of techniques. So technically, creative accounting practices such as choosing among acceptable accounting methods or making estimates are legitimate and within the bounds of accounting standards. Ethical boundaries, determining the ethical boundaries of creative accounting is challenging, as action may be technically legal but not unethical if they grossly misrepresent true value of lead stakeholders. Ethical evaluations managers and accountants must carefully evaluate the ethical implications of their actions, considering the potential impact on stakeholders and the integrity of financial reporting. So basically, Hinesh, what's your comments on this? I believe that there are kind of tricky things. Okay, both sides, they are playing both sides of wicket. You know what I mean that?
Yeah, so this is the point of doubt.
It's
Rather than placing doubt on what is considered to be ethical.
yeah, it is very that I don't understand. Same time, one thing is wrong, but same time they said, oh, it is illegal or unethical. That it's a kind of tricky stuff.
Yeah. Okay, brand accounting.
Yeah,
This is based on marketing. Marketing is based on perception. Perception is based on somebody's views.
yes,
Now, you if you're a scientist, you only base it on facts and evidence. Then there is no movement on the view of ethics, because ethics is also based on the truth, which is
yes.
based on evidence, based on facts.
Yeah,
Uh,
based on evidence, facts, truth, and legal stuff. Ethics
yeah,
mean it's also
yeah,
legal.
and
If you are talking about legal or illegal activities, so ethics are based on legal activities or legal stuff.
yeah, yeah, and it's not based on a personal view. It's based on the values, the positive values that have been instilled from the framework, the original corporate uh, financial framework, which states, right, these are your 10 commandments that you must not commit as
Yeah,
sins. So you know already that, okay, if you're going to create or innovate something, you go back to the framework and you ensure that those points are not breached. Full stop.
yes,
Yes, there. So Coca-Cola is a brand, but Coca-Cola is such a big company. It it is a brand that is well known. How do you value that brand? Well, you can't value it based on somebody saying in the papers that it's the biggest brand, and so therefore it is considered to be valued at X amount.
oh yeah, but not because of basically name, not because of it's a famous, or it's that. So
Correct. It's how much in its true substance. What
yeah,
is substance? What's its true value? And the valuation is assessed by the way that the company has operated, how it has uh, contributed back into society. So has it paid its obligations to society, or has it just simply looked after itself within the community
yeah,
and has remained selfish? And yes, in the beginning, it has done that. It knew well that one of its ingredients was cocaine. When it was first created, it had a drug, and it wasn't for social drinking. It was created as a medicine. Does it fulfill that brand? No, it doesn't. In fact, it's completely opposite. The contents of sugar is the world's biggest poison. Why is it considered a poison?
yes,
Because science has shown that too much sugar in any body, any human organic body, can actually destroy the longevity of that body. It disrupts its repair mechanism, it disrupts the thought processes, it creates a manipulation in the way the body is able to repair itself as well. That's why people are suffering from diabetes. That's why people are suffering from Alzheimer's. That's why people are dying before they are meant to, because the body has been disrupted in such a way that it's imploding rather than increasing and improving. And media are also to blame in the way that kind of the messages are sent. You know, they're saying that this is natural foods, or this is got no added sugar, but genetically the ingredients have been modified in such a way that it already has the sugar content way too
Yeah,
high.
even if you look at another, it's my personal opinion that zero sugar is kind of, that I don't know how they say zero sugar,
Yeah, so they use artificial sugar,
Yeah,
and
they still
artificial
use
sugar is
sugar, you
man-made.
know that. They're just
Yeah,
manipulating things.
yeah, sweeteners. It's
Yeah.
chemicals, and these chemicals are not biological. They're actually chemicals that work against our bodies. And now in society, in modern society, people who live in industrialized areas, it's affecting their gut. The gut is now, science has discovered, is our second brain. It has more
That's right.
neurons and nerves than our brain itself. It gives us the messages back to our mind, and then our mind is trying to survive or try to continue performing, but it gets confused because it's been given the wrong messages from our gut.
Right. So we come to the conclusion. Creative accounting should be used if it is within the ramifications of the law and achieves the company's ultimate goal of increasing stock value. Basically, is trying to say the use of creative accounting should be evaluated based on its legality, alignment with the accounting standards, and ethical considerations, while it can be employed to achieve legitimate business goals and ethical or enhance shareholders' value. So, it must not compromise the integrity of financial reporting or mislead users of financial statements. Companies should strive to benefit both in the short run and long term. So ensuring transparency and accountability in their financial position or financial statements. So that's it for today, Hinesh.
Ah,
Some links for statements are manipulated and why. You can visit Investopedia. Uh, their financial ratios, enterprise, any questions or any concerns. So here's some for further knowledge bank again. It's Kaplan ACCA chapter 13. You can visit, and if there is any question, you can drop me an email as well, yasir@ukversity.co.uk, and you can also, message me. So thanks. And next one is our last lecture of accounting, assignment. So any questions, concerns, issues, Hinesh?
yeah, can you just go back to slide 26, 27, 28, and 29, please?
Uh, 26.
Yeah.
Yes. WorldCom scandals.
Yeah, yeah, 27, 28, and 29.
Yeah, that's the 27 WorldCom scandal. And then 28 American Insurance Group. And then Lehman Brothers 28, 29 definitions.
Yeah, perfect.
Yeah, okay. So that's it. So I'll see you next Saturday, I think so. I believe so, but anyway. So
Yeah,
also check your learning management system. If you have any issues, Hitesh, just let me know, okay? I'll
yeah,
try to sort out as soon as possible, okay? So our next lecture is will be discussion based on assignment. Will be assignment discussions, okay?
yeah.
So thank you very much for today, Hinesh. Have a good weekend. I'll see you next weekend, okay?
Yeah, next weekend, and yeah, I'll try ensure I'm able to connect on time.
Yeah,
Sorry about that.
no problem, Anish. No, I know that. I realize weekend, so you have some other things to do. You know that. So thank you
Yeah,
very.
and my devices, the Wi-Fi connections, they're a bit of a problem at
It
the moment.
does happen sometime. I missed last lectures, not yours one, another lectures,
Mm,
business organizing because my net wasn't working. So it does happen sometime anyway. It doesn't
yeah,
matter.
yeah.
Anyway, thanks, Anish, and I'll see you next Saturday at 10
Okay,
o'clock.
thank you.
Okay, bye.
And I can get a recording of this
Yes, you
lecture.
will get recorded lecture by Monday, I think. So they will send out Monday morning. So you will get recorded lecture as well.
Okay, thank you.
Okay.
Thank you very
Okay,
much.
thanks. Thanks very much. Bye. Bye, Hinesh.